Well, thanks for doing this. Thanks to the Chamber. Thanks to the coalition. I really admire what you guys are doing. You know, a lot of you are in this business because you understand the moral case for development. Many of you are here because you understand the strategic case. But I wanted to do a bit on the economic argument. Although that was the best economic argument I've ever heard, and it uses most of the arguments we try to make. I actually began, I sort of got in this world really early in life. I lived as a kid in East Africa and India and Thailand, and I grew up around a bunch of people who were in development business in the bank and CARE and Oxfam, and I got interested in government really by looking at the impact the U.S. had in the world at that time. And it's nice to be in a position where I have some chance to affect those policies. I think a lot of people ask, what's the growth strategy for the country going forward? And I think the most simple way to say it is exactly the way the video did. We're a quarter of the world's GDP, but we're only 5% of the world's population. And most of the growth that's going to come in the decades ahead is going to come in those most populous, the poorest emerging economies around the world. And our sort of single economic imperative, if you think about it, is how to design an economic strategy that makes it more likely that we have a larger share of that growth. And a larger share of that growth is met by companies that are creating and building things in the United States, or by companies that are headquartered in the United States. And if we're successful at doing that, which I'm very confident we will be, then growth will be much stronger in this country than it otherwise would be. Now, why the World Bank, the MDBs, the International Affairs budget? I think you all understand this case, but let's just go through it. They're like trade agreements. They have probably done more trade liberalization at the expense of some criticism, actually, more opening of trade markets and investment markets than we have done through bilateral trade agreements. They are, as Lael Brainerd likes to say, the Undersecretary, she likes to say, they provide the soft and the hard infrastructure for what market economies need to work. So they don't just provide most of the financing for infrastructure projects, which are a big source of export opportunities for us, but they are the instrument for most of the soft infrastructure for what makes market economies function, meaning the framework of property rights, governance practices that limit corruption, procurement policies that provide for a more open level playing field, investment environments that are more conducive to foreign investment. That soft infrastructure for market economies is critical. And as you saw in 2009, they are a critical, essential part of crisis management response. In 2009, what stopped the arrest of decline in trade globally, the fall in exchange rates around the world, and the collapse of trade finance around the world was when, at the initiative of the president, we got the world to put a huge amount of financial force through the MDBs and the IMF behind a strategy to arrest the decline in trade finance and exports and growth. And we would not have been able to do that without the MDBs. And part of why we're here seeking authorization for a bunch of replenishments and capital increases is because we were successful in getting to play such an aggressive role in the early stage of the crisis. And there is no way that growth would have come back globally as quickly as it did and as broad-based as it did if we had not been able to use those institutions that way. Now, we're at a time where we have extraordinary constraints on limited taxpayer resources, and probably, just given the magnitude of the basic challenges we're asking Americans to bear at home, a much more difficult political environment for financing these causes, these programs, than we faced, I think, in decades. And that's another reason why it's important to help people in the Hill understand what the MDBs actually do, because they provide the best leverage for $1 of taxpayer resources of anything we do globally. Tremendous leverage, because our money comes alongside the money of the other shareholders, and in most institutions, they can use that to borrow substantial sums in the capital markets. So it's excellent leverage. Think about it the opposite way. The more we restrain their financial capacity, then you have a multiplier effect in their lending capacity. We hurt them much more if we starve them of resources. And so this is important. As you think about trade-offs across the international affairs budget as a whole, we want to concentrate our firepower on the relatively small slice of that budget that goes to the World Bank and the multilateral development banks, because they come with leverage, unlike the vast array of bilateral programs we deal with. Just another more general case to think about. If we were unable to get Congress to fund these commitments now, then for the first time in really generations, we would face across the institutions a substantial loss of influence. We could lose our veto in some institutions. We could actually prevent, in some cases, if we don't act, some institutions won't be able to go forward. The IDB is a good example of that. And we face a greater risk of loss of influence and therefore less ability to help shape the conditions they bring when they bring their programs, and that will work against the broad economic interest of the American business community. I think if you think about the long-term imperative, we should be doing everything we can to make sure we are able to continue to play a leadership role in these institutions. I think there's a really overwhelmingly compelling economic case for it, very strong security case for it, apart from the basic moral commitment that's always guided U.S. policy in this area. Now, Myron asked me to say a little bit about the near term. The U.S. is obviously slowed. Growth has slowed. It's slower than it should be, slower than we'd like it to be. We started the year with a bit more momentum. People thought the U.S. would be growing about 3.5% roughly over the course of the year, and it turned out to be more like 1% to 2%. And that happened because we had a bunch of bad shocks at the world economy. Oil prices went up. Japan had a terrible natural disaster. You had a variety of other temporary things that pulled down growth in the first part of the year. But those things are fading. Japan's coming back. Oil's not all the way back to pre-crisis, pre-Arab Spring levels, but it's coming back and gas prices will follow. But we have these two big clouds over the American economy, global economy now. One is Europe, and the other is the basic concern about whether the American political system can do anything now, is able to act on anything, able to legislate anything and be good for the economy, good for growth now. And that skepticism, concern on the U.S. side is significantly a result of the debate over the debt limit, but it's not just about that. It's not just the spectacle of seeing Congress debate whether we should meet our obligations as a country. It's just about this crushing sense that the country's too divided and Congress too divided to actually move on something. And that's something we got to try to fix and change. Europe, not least because we don't want to be vulnerable to whatever pressures Europe continues to put on the global economy. Why would we want to be in the position where we don't buy ourselves more protection against the risk that Europe chooses to drift? One reason why we want to pass this package of growth initiatives is not just to get an economy growing too slowly to grow faster, but so we have a bit more protection against the risks that Europe presents. Europeans are trying to convince the world now that they understand their way behind the curve and they're going to catch up and get ahead of it and put in place a more powerful financial firewall around Europe, behind their financial system and behind the weaker sovereign countries. And what they've tried to do over the weekend, with the encouragement of all of us, is to signal more definitively that they're going to escalate and accelerate that basic framework. And you've seen a little bit better tone in markets globally now because they've tried to make that commitment credible. But they haven't acted yet, and we're trying to get them to move as quickly as they can so that they bring a little measure of stability to Europe. I think it's very unlikely that they're able to find the political will to do a clean, crisp resolution, move towards fiscal union, take the more dramatic steps that would be a more decisive response. But they have the capacity to, and it's, I think, very likely that they do enough to hold things together, to cool the temperature a little bit and diminish some of the pressures we're seeing. We've been hurt not just because growth in Europe is weaker than it otherwise would be, but that's not the most significant effect. The most significant effect it has on us is through the financial system and what it does to confidence globally and what it does to people's willingness to take risk. And it's been very damaging. It was very damaging last summer. U.S. equity prices fell 15%, mostly in response to Europe. And it was very damaging this summer. And we're still living with damage that caused. We have a huge economic stake in trying to get them to move. And as you know, the IMF is at the center of that effort. They need, and we want the IMF there, not principally because of the financial assistance they provide, but they need an independent arbiter of the economics conditions of the programs they're supporting, because they don't trust their institutions to be tough enough on policy. I don't mean tough in a negative sense, just or strong enough, independent enough to validate what's a credible reform program. And I know there's a little bit of resistance on the Hill to the IMF being involved, but we're going to be very supportive of making sure the IMF is there, playing a very active role, because we have such huge stakes as a country in them getting through this. But all the growth and all the export growth and the sort of dominant source of strength that we're going to see for exports as a country going forward is going to come from the emerging economies, which are the principal beneficiaries, principal object of the MDV programs. And we think there's an overwhelmingly compelling economic interest in trying to make sure that we can continue to play a leadership role in shaping what they do, because they do things that are good for growth in those countries and good for U.S. exports.